Hey guys, welcome to another video here. So what I wanted to show you guys was the Ford Motor Company analysis. So for all you investors out there and anyone looking for a safe return and financial freedom for the next year, I just want to give you a few pointers and tips on a company that may cause you guys to get returns that are safe. It's not like the cryptocurrencies or the Pi Network or Dogecoin or any other of these cryptocurrencies that have been really volatile and unsure of any profits. So with no further ado, I'm just going to jump right into the video here. So the Ford Motor Company analysis. Um, so right away, we're already looking at the liquidity of it all. We want to know, like a safe company, you want to make sure that it's liquid. So for example, like Ford, they have their vehicles, their trucks, their their Mustangs, and all their equipment that they could easily sell if they needed to come down to it. But although they've been a century-long company ever since Henry Ford started the company way back in the early 1900s, the current ratio is 1.2 in 2016, 1.23 in 2017, and 2 in 2018. So I'm just pulling stats here from the last 3 years that are just going to show, or from the past, the middle of the 2020s or 20 teens. The quick ratio 107, 108, 104 in 2018. With the given ratios, we can see that Ford is a liquid company in the short term. So what that means is that they have they're pretty safe in the short term. And throughout my research, I found a quick ratio of 1 is healthy. The quick ratio of Ford tells us that they have enough money to pay off their current liabilities without having to sell inventory and any other assets, which means they have a pool of cash or reserves just like a bank would have if they go under, to pay off any liabilities or debts or indebtedness that they may occur. The current ratio tells us they can pay off the short-term obligations. The debt management, the equity multiplier is 8.16, 7.39 in 2017, and 7.14 in 2018, and it's been going lower and lower all the way up until 2021. The high equity multiplier indicates Ford does not use much stockholder equity to finance their operations. So that tells us, for us investors that invest in Ford, that we're safe. Personally, I am not invested into Ford right now, but I would recommend it because they're not going to be taking too much of our cash. They won't be taking too much of our cash as an investor, and the price will just continue to rise slowly. And it's a mature company, so they don't need to be taking too much stockholder equity to finance their operations. Healthy equity multiplier is around 1 or 2. So you see, like Berkshire Hathaway, they probably have a 1 or 2 debt ratio. 0.88 in 2016, 8.7 in 2017, 8.6 in 2018. The given debt ratios in these 3 years indicate that Ford had enough assets to pay off their debt obligations. So what this is telling us right here is that that they clearly, what I was already saying in slide 1, they clearly do not need any more assets than they have to pay off their debt obligations, which is a good sign. The low debt ratio indicates Ford is safe and a low risk. Not much chance they'll go under and need to sell off their assets to cover debt. Asset management. Total asset turnover, 0.61 in 2016, 6.3 in 2017, and 6.4 in 2018. The low total asset turnover ratio indicates that Ford's assets are working for them, but not in the most efficient way. Now this is, one downside of the company. The higher ratio, the more efficient the assets work for them in the operations. So this could be like their assembly lines or, their technology, their ERP systems that they have implemented into their company. So that is one section that, as an investor, you're going to have to keep an eye on, is their factories and how efficient their factories are producing vehicles. The inventory turnover ratio is in good shape. You can see in 2016 it was 12.49. 2017 it was 12.96, and 2018 is 13.45. The higher the ratio, the quicker they replace sold goods. So, as soon as a car is bought, as soon as they send it off to a dealership, or as soon as they make a shipment overseas, wherever, Ford is all over the world. It's worldwide. So as soon as they sell a vehicle, they're normally replacing these goods, which is a good sign for an investor. They may need to work on efficiency of their assets in production, but are very well managed when it comes to replacing their sold items. Profitability, or return on assets, 1.83 in 2016, 3.03 in 2017, 1.47 in 2018, ROE 14.79 in 2016, 22.81 in 2017, 11.03 in 2018. On average, a good ROA is about 5%. Oh, never mind, I was reading the wrong one, but 1.83, 303, and 1.47. The low ROA indicates that Ford struggles to utilize its assets to produce net income. Ford also has a low ROE ratio, which indicates they are not very efficient using stockholders' equity. But, I think the reason why that is because, they don't use much of the stockholder equity to produce or to pay off any of their indebtedness or indentures. So, Ford Motor Companies have shown signs through their ratios that they are profitable, not in large amounts by any means. So, if you want a safe investment to put into your index fund, or if you're looking for a 401k or like something to put into your 401k, Roth IRA, you name it, Ford Motor Companies is a wonderful company to get into. There's a few downsides, but like I said, keep an eye on their news about their production in their factories. I know like their new electric vehicle coming out. Keep an eye on that to make sure that they can replace those goods sold, which on track they've always shown that they can. Check to see if their factories are producing very efficiently. And in conclusion, Ford is low risk, low reward type of investment, low profitability, very liquid. Average would be better off to invest for the long term as it is in a safe investment. Is pretty much what I was saying in the beginning of the video. Would be fine to invest in the short term, but ROI would be low. So I think, if you have a good farm of cash to invest, this would be a really, really good investment to get into. And it's something that you'd want to put into your 10, 15, 20-year plan. In later videos, I'll get into the Pi network up here. Personally, I'm mining this myself. Technically, it's not mining because we're just using credits that are allocated by the doctors who created this whole network. But if you guys are interested, this will be in the next video. Make sure to subscribe below, like the video. I really appreciate that. That's going to be a huge difference. So for the following videos, I'll be getting into the Pi network. And with all that, we'll see you guys on the next video. Thanks.